Our course on credit risk analysis and rating is now live. The link you can find in the description right below this video. Let's say we are renewing a CC limit of 10 lakhs. Before you work out the projections and estimations, the first thing you do is to take a look at the previous year calculation, just to ensure how the unit has utilized the limit. So how to figure out the eligible working capital limit in turnover method? Our turnover algorithm says first you take a look at the gross sales. Let's say it is 75 lakhs. Then you calculate the working capital requirement, which is 25% of gross sales, that is rupees 18.75 lakhs. Now you determine the margin to be brought in by the promoters. And how to do that? We consider two sets of values, 5% of gross sales or NWC, whichever is higher. Finally, we deduct the margin from the working capital requirement to arrive at the eligible limit. Now, going by this example, what could be the maximum margin so that our renewal sails through smoothly? Remember, we are renewing a limit of 10 lakhs, right? The maximum margin without a botheration could be 8.75 lakhs. Now 5% of the gross sales, which is one of the possibilities of margin, is perfectly alright. But before you celebrate, take a look at their previous year's balance sheet to find out the other possibility of margin component. NWC in this case quite painfully comes down to 10 lakhs. That is above the threshold limit of 8.75 lakhs for the margin we arrived earlier, isn't it? And shockingly, the eligible working capital limit is 8.75 lakhs. So what to do in this kind of situation? How you are going to renew the account? I know you are a smart banker and you have watched my previous contents on MPBF. So you try your luck in that route as well. Working capital cap comes down to 20 lakhs. 25% of current asset is 15 lakhs. So the eligible finance comes to 5 lakhs. Now you are stuck in Bermuda's Triangle. This technically means that you have overfinanced the unit. Now what? Can you afford to recall the facility or reduce the limit? I couldn't. If you are thinking of doing reassessment by cash budget method, then my sincere sympathies with you. Because in my 15 years of career, I never met a small ticket borrower or even their accountant who knows what a cash flow statement is. In banking, either you know the work yourself or know whom to call in need. Phone a friend option, you know. When I get stuck in a similar situation, I often make a call to industry veterans who have been in this kind of situation before. And believe me, the results are quite encouraging. When you assess the limit of the borrower last year, everything was fine. You did the arithmetic based on projected financials. Now the transactions in the account look absolutely great. Practically speaking, as a banker, you have no complaints against him. So what according to you could have led to such situation? It's the temporary surge in current asset level which in turn increased the NWC. Remember, NWC is calculated by current asset minus current liability. So increase in current asset will definitely stretch the NWC as well. This usually happens when long-term funds brought in by the borrower in the form of equity or unsecured loan from friends and relatives. Sale of fixed assets or non-current assets. It should be noted that these funds are meant for investment in fixed asset or non-current assets in future. These are temporarily parked in cash or bank deposits or short-term investments, resulting in temporary surge in NWC on a particular date. So, you inquire the sources of such high cash balance right at the end of the financial year. Basically, what happened is that the person had a long-term investment in the form of LIC or NSC which matured right at the year end. So, he infused that in the form of capital for the business. This increased the liabilities. Quite obvious, isn't it? But how to compensate for the asset side? How much and where it has to be added? He plans to purchase a new set of machineries, but before that transaction could materialize, he parked the amount in cash and bank balance. And this made our calculation to go for a spin. So what do? We take a declaration from the borrower stating that rupees X was brought in by him with an intention of investment in non-current asset or fixed asset in the next financial year. So, the margin was intended for fixed asset and not the current asset. You verify the same from the projected balance sheet and find that what he is stating is nothing but the truth. There is a clear-cut increase of fixed asset or non-current asset as well as capital or long-term sources that he has mentioned. Now you can very well go ahead with the renewal. Happy? If you like this content, you can also take a look at our full-length credit tutorials. The link you can find in the description right below this video.